All right. We have been here before. Unfortunately, we will be here again. That is the one thing that we know for sure. We are going to go through multiple market corrections and pullbacks, just like we're going through right now. And I know that's not what we want to hear. I know that this is not fun. It is really hard to go through market corrections like this. It is not easy to log into your portfolio, see your account values down, see red, hear everything that you've been hearing on the news, in the media, to listen to your friends and see people posting crazy things on social media. It is not easy. I know this. I know that this is also what sets you apart, what sets us apart as investors, because it's not easy. There is a cost to investing. We don't just get to allow our money to just make free money for us. The cost is that we have to get through the painful times, and we're going to have many painful times in our investing career. And it is the name of the game, and it's unfortunately something that people really, really struggle with because it goes against our nature. It goes against what we feel is right in our bones. When the world is, really volatile, we want to protect what we have, and it's hard. It's really hard to trust the process and to go against that natural inclination. And it's the reason that so many investors really struggle to be successful in the market. It's the reason that not all of us are millionaires, that people really, unfortunately, continue to make the same mistakes over and over and over again. There's a statistic that I'll show you in a second, but the average investor has only earned 3.4% over the last 20 years, when the S&P 500 has earned about 10%. Why is that? It's because we let emotions take over, and it's really hard to have perspective. It's also one thing to know, okay, markets are volatile, they'll come down, they'll come back up. We know that. It's another thing when we feel like, this time is different, when we feel like it's coupled with or caused by all of these other broader macroeconomic things that are happening in the world around us. And, that's the rub. If we always felt like, oh, yes, we're going through volatility, but it's normal, it's no big deal, we will recover, everybody would be doing it and everybody would be successful. The rub is that it feels like when we're really going through corrections like this, it feels like this time is different. It feels like we're never going to recover. All of the historic data and historic slides that I'm about to show you don't matter. They won't matter because this time is different and we're not going to experience the same recovery that we always have. That's what we have to break through. We have to break through and really shift our mindset to looking at times like this as opportunity. It's an opportunity to buy in, to buy shares at a discount on sale. And I know that's hard. I know it's not easy. I know it goes against our natural inclination. But again, hindsight's 2020. When we think back to COVID, I hear it all the time. People tell me they wish they would have bought in. They wish they would have put more money into the market when everything was on sale. There was a 35% discount pretty much overnight, and it was followed by significant growth, significant recovery. And, 2008 at the time felt like this time was different. It really felt like, this is the banks, this is the financial institutions collapsing. There's no way that we're going to recover the way that we have. All of that data, everything that's happened in the past doesn't matter because it's never been the banks before. It's never been financial institutions before. We're not going to be able to recover when the institutions themselves are collapsing. But sure enough, looking back, if we could have only put more money into the stock market during 2008, right? Again, it's hard to have the perspective. It always feels like this time is different. And to be honest, it is. It's always different. It's always really hard. Whatever it is, whatever we're going through, it is new. It hasn't ever happened before. It always feels really hard in the moment. And again, we know that we're going to be faced with multiple events like this in the future. We're going to go through really hard times, and we have to play the long-term game, which means we ride the volatility and we're not being reactive to what's happening around us. Anytime that we're reactive and we are tempted to want to do something, again, it's our human nature to want to do something, pull money out of the market. We want to hang on to it. We want to reallocate, rebalance, want to buy something different. We want to do something to feel like we're in control. But really, when we're reacting to what's happening in the news around us, what's happening in the markets around us, we're losing. We want to be proactive and not reactive. We want to make sure we are invested in such a way that we are set to weather the storms. And that's an important distinction. It's something that is really important to understand. If you are not invested in a strategic long-term portfolio, if you are not properly diversified, none of what I'm saying holds true. If you are day trading, if you have stocks on Robinhood, if you have a few individual stock positions that you own, you do need to seriously look at the health of that stock. When we're going through volatility, you need to look at, is this company going to be able to recover? It's not easy. That's not an easy decision to make. It's not an easy place to be. Something I always like to say is minimize your maximum regret. If you are in that position and you are looking at a singular stock, run the scenarios. If you sell now, take your losses, and the stock recovers and soars and you could have had thousands in your portfolio, are you going to regret that decision more than if you stayed in and that stock went to zero and you lost everything? Which decision are you going to regret more? It's not easy. It's still a hard decision. Still not a good place to be, but you do have to play that game. And again, just understanding that difference between, are we invested in that strategy? Is that the type of game we are playing? Or are we invested in a long-term diversified strategic portfolio that is literally meant to weather storms like this, that is created to just ride the ride? Because when we're invested in that way and we decide to sell out now, all we're doing is locking those losses in, and we're preventing ourselves from capitalizing on any of the recovery. And that is a really, really important piece that we have to make sure we understand. I am going to share a few slides. Again, I sound like a broken record. I know we have been here before. We've talked through all of this before, but I do think it is good to just see some numbers and really put things into perspectives. Zooming out and really looking at our past events, we have been through a lot since this is showing back since 1970. We have been through a lot, and every major crisis that we have been through has felt at the time like the sky was falling, like the markets were not going to recover. Like this time really was different. And again, that perspective of zooming back out and looking at where we are today, the markets do recover. And again, if we could just trust that, and we had the opportunity to put money in during those dips and declines in the market and ride this recovery, ride the bull market when it comes, we would do that now because we have the clarity, and we just have to trust that no matter what it is, again, there's going to be multiple events in our future, that it's going to be the same story. We just don't know exactly how long the correction's going to last. We don't know exactly how deep it'll be. But if we have that long-term perspective, we know that we just have to ride the ride. Again, I talked about this earlier, but just showing that the average investor over the past 20 years has only earned 3.4%, whereas the stocks, US stocks, S&P 500, 9.7%, real estate, 7.6%. It just goes to show the impact of making emotional decisions and getting out of the market during times like this when you're locking your losses in, and also missing out on the best days. That's a big part of that number and why the average investor has underperformed is because it's really hard to time the market. And it again feels natural to say, well, let's just pull out now, take the losses that we do have, and I'm not going to stay out of the market. I'll put my money back in when I feel more confident in where the world is headed, where the economy is headed, what's actually happening. Let's just hold on to what we have for now, play it safe, and let's put our money back in when we feel better. That is a natural inclination. And all it does is it allows us to fall into that trap of selling at a loss and buying back in at a high, because when do we feel better? We feel better when the market's recovered. We feel better when consumer sentiment is up, when the world is doing better, when everyone around us is more financially healthy and stable. And all that does is it causes us to miss the recovery cycle. It causes to miss those best days. And that's what this is showing is, 7 of the 10 best days occurred within 2 weeks of the 10 worst days. And if we had missed just 10 of those best days in the market, so showing a $10,000 investment between January 3rd, 2005 and December 31st, 2024, our $10,000 would be $32,000 instead of $71,000, 6.1% as opposed to 10.4%. And that's just missing 10 days. And you can see, what if we sat on the sidelines and we missed a month? We missed 30 days because we don't know when the bottom is. And it's really hard to predict when that bottom is and when we're going to see that recovery. And again, we typically see the recovery and we see the best years in the market following the worst. Following the worst corrections that we've had, we've seen really positive returns on average. And you can look at this chart and you can see these numbers. I like to really have you zoom in on some of these actual dates that we really remember, that are fresh in our memory. If we look back at 2020, really good example, markets were down 33.92%. Again, felt really, really significant. 2020, really, the world was shutting down at a global scale, and it did not feel like we were going to recover. And we got really lucky because we didn't have to wait long to start to see, on a stock market level at least, to see the recovery. Within a month, we started to see significant growth following that really scary decline. And that's what you see here. 1 year later, 74.78%. Markets were up 74.78%. 2 years later, 41%. 3 years after, 20.85%. We look back at 2008. 1 year later, 19%, 13.8, 9.94. We look back at just 2022. That was a really rough year for us because, unlike COVID, we really had to be patient during 2022. Markets were down pretty much all year. So we really got our patience tested. But just like every other time, guess what? We saw really great returns in 2023 and 2024. So again, the reason that we've been at such a high and we've been feeling so good in the market over the last couple of years, why we've been in this recovery stage, is because it is a recovery stage. We get the momentum to go up after going down. And so we want to participate in that recovery. And it's really hard to predict when is the bottom. I've been getting that question a lot of, okay, I'm bought in on the idea of taking advantage of this opportunity. I know that prices are lower right now and things are on sale, but I think it's probably going to get worse. So we should just wait until it gets worse. The hard thing about that is we don't have a crystal ball. We don't know. Is it getting worse? It very well could. We believe that it probably will. We probably have some more volatility ahead of us, but we don't know that. And I always like to make decisions based on what we do know versus making predictions. We know that we are seeing the best buying prices that we've seen in 5 years since 2020, since COVID. We know that we've been sitting and waiting for buying opportunities because the markets have just been all-time high after all-time high after all-time high. We know we can get a discount right now. We don't know what tomorrow holds. We don't know if it's going to continue to go down from here or if it's going to be a COVID situation where we do see significant rebounds. We don't know. We can hedge our bets. We can dollar cost average, put some money in now, hold on to some and plan on investing over the next couple of weeks and over the next couple of months, hoping that the markets do come down a little bit more before they see that recovery. That's a good strategy. But either way, again, I like to make decisions based on what we know. So stock market corrections, again, are very normal. It's a normal part of the process. It's a cost of investing. We have to get through these painful times to really get and reap the rewards of being in the stock market. And this is just showing that annual returns and pullbacks and corrections are very, very normal. What would actually be not normal is not having a drawdown in a given year. If we look back at all of these years in our history, the red dot is showing the biggest decline over that year. So again, COVID, 34%, big drop, but actually we ended the year positive. The graph is showing how we ended the year. So we were up 16% in 2020, even though we were down 34% in March, which again, in that moment felt like the world was ending and the sky was falling and the market was never going to recover. And again, that perspective 1 year later, where we were. And also one thing I want you to pay attention to in this chart as well is that the market ends positive a lot more often than it ends negative. If we look back, this is back since 1980, there's only been a few calendar years where the market's been down. And that's actually just leading us into the next slide, showing that the market is actually up, the market is positive 74% of the time in a 1 year period. So again, we don't love to compare long-term strategic investing with gambling. If we're invested in individual stocks, we need to treat it like gambling. We need to understand that that's what we're doing is gambling. But if we're invested for the long run, we don't like to compare it to gambling. But if we were gambling, 74% probability of having an upside win, those are pretty good odds. Again, if we give ourselves a longer term horizon, if we have 3 years, 5 years, 10 years, 15 years in the market, we have a 100% probability of the market being up, 100% probability in a 15-year period, which is why we always say we're invested for the long term, because we know that if we just have time, if we just give ourselves time, we will recover. And I hear this all the time from my retired clients. They'll always look at me and say, well, I don't have time. I'm retired. I am close to retirement. I always remind them our investing career doesn't stop day one of retirement. People are living 20, 30 years into retirement now. So we have money that is positioned for that 10 years, 15 years, 20 years down the road. We do have money that is and should be in the stock market for those longer term timeframes. We shouldn't have all of your money in the stock market. All of your money shouldn't be in the S&P 500. We should have money set aside so that if the market's down over the next couple of years, if it takes 5 years even to recover from whatever correction we're going through, we have cash set aside, we have fixed income, we have bonds set aside, but we also know that, hey, we do have equity positions that are geared toward just getting through the storm and going through the volatility, and they will recover. This really puts it into perspective, bull and bear cycles, and also just reminding us that, again, bull markets also last a lot longer on average than bear markets. And this is showing, again, recently, 2022, markets were down and it did test our patience, but they were down 9 months. And it was followed by 2.5 years of growth and recovery in a bull market. And we saw that again, 2020, quick dip, followed by almost 2 years of significant growth, significant bull market. 2008, very painful, a great recession, a very painful moment when it comes to market declines. It lasted 1 year and 4 months. and then was followed by almost 11 years of a bull market. Again, we could go back all the way from 1956, and you just can see that bear markets are actually a lot shorter and a lot less common than a bull market. And also looking at recessions, which is a good thing to talk about as well right now. Recessions, if you notice, are actually really closely followed by these bull markets. And that's something that if you've been listening to me over the last couple of years, you're probably sick of hearing me talk about a recession. We have been talking about and predicting a recession since COVID. We have felt like it would be really hard for the Feds to be able to lower rates to pre-COVID levels without a recession. People have been spending money, regardless of inflation, at such high rates that we felt like real financial and economic pain was probably necessary in order for the Feds to truly be able to lower rates back to pre-COVID levels. And so a recession we have felt like was very likely. So we've been talking about it. We've been talking about it for a long time. We've been preparing for it, preparing people for it, and it just hasn't happened. And so we got a little tired of talking about it, honestly, but here we are again. It's back in the news. Everyone's predicting a recession again. Again, it's never fun to go through these downturns, but if we do see a recession, it's also not something that we're worried about. And I just want to hone that in again, that it's the same story, whether it's a recession, whether it's the corrections we've been talking about. We know that recessions, corrections are always followed by good growth. So we just have to be able to get through the recession. And yeah, it's not fun. The average drawdown during a recession is 30.6%. So if we do see a recession, we absolutely could continue to see more volatility from here and an even deeper correction than we've seen. We know that the average drawdown is painful. It's not fun to go through. But again, we look back and we see, okay, 1 year later, 3 years later, 5 years later, if you notice, after the recession, the markets are always up, and they're up at pretty record levels, 43.8% on average, 65.1, 101.3 5 years later. So we do know that, yes, it's not fun to go through them. On average, the average recession lasts 13 months. We know it's followed by good growth. This is just showing too, the stock market is a leading indicator. So typically we'll see the stock market go down before a recession, leading us into a recession. And we'll see the stock market actually start to recover well before that 13 months is up, well before the recession is actually over, leading us out of the recession. And that's what this is showing too. We start to see that recovery cycle. This average line kind of shows it a little bit clearer. This is the end of the recession. Stock market actually starts to trend upward and starts to recover well before the end of the recession, and again continues to go up and have really solid returns following a recession. So biggest thing with recession risk, and the biggest thing we've been preparing our clients for, is we have to be able to get through it. And, again, stock market perspective, if we have that long-term horizon, we're not worried. We know that that's how we're positioned, is to just weather through that. From a financial perspective, outside of the stock market, we need to be prepared to potentially lose a job, because that is the biggest concern for us. It's not about the stock market. We're not concerned about the stock market in a recession. What we're concerned about in a recession is that we lose our job and we don't have income, and now we need to tap into our emergency reserves and our savings. And that is what can be detrimental for people, is that if they don't have enough emergency funds, savings, they don't have enough diversification, fixed income bonds in the portfolio, and they do lose a job and they're in a desperate situation and need money, they're left with a really difficult choice where the only money they have is in the market, and the market's down, and they don't want to lock in those losses. They know better. They want to be able to ride it out, but they have no other choice. It's all that they have, and they don't have a job and they don't have savings, right? That is the situation that we want to avoid. God forbid that money is in a retirement account too, and they have to take penalties on top of taxes, taking money out. So we want to make sure we are diversified. We have savings. We have fixed income and bonds in the portfolio as well. And we are in a good position to get through loss of income during a recession. So it's, one of those funny things. My retired clients are always the clients that are the most worried about recessions. And I always tell them they're the most secure. They have their income. They're not worried about loss of job. If they go through a recession, yeah, it's not fun. There's still other implications of a recession, but really they have their income. We have a long-term plan. So we should be the least worried, really. Showing in, a different format, the average return 1 year later, 3 years later, 5 years later, and 10 years after a recession. So just reminding us again, there's a lot of positivity on the other end, on the other side of this pain that we have to go through right now. Again, I know it's not easy, and it always feels like maybe I have rose-colored glasses and I'm always trying to, kind of have the same conversation regardless of what's happening. And that's the reality. It doesn't really matter what event is causing the correction. It doesn't matter why. We have to kind of break through that thinking of, oh, this time is different. It's because of, now tariffs and this fear and this uncertainty of what those tariffs are going to mean for companies and the economy. It really doesn't matter the reason for that, because again, it's just having that long-term perspective. Whatever the reason is, there's going to be multiple events in our future that are going to cause similar fear and concern in our society, in our world, in our economy. And we just have to really be able to tune out the noise and just trust that we are invested for the long run, and that we will recover and we will see the other side of this, and we have to stay the course. So I know you've all heard this before. You, again, will hear it again, but I hope this is helpful, and I hope that this can help you just breathe easy and just get through this next bout of volatility, and know that I know, again, we all want to do something. We always want to take action during times like this, but hopefully this can just help you remember that really we shouldn't be making reactive decisions. We've been prepared for this volatility. And that's another thing I'll say is the worst corrections that we've seen historically going back, majority of them, we have not had any idea they were coming. They were completely, caught off guard. And this is not the case. This is something now, what's happening now, that we have been prepared for. We've been talking about for a long time. We've been expecting volatility. And we've known that these tariffs were likely. I think we've seen this deeper downturn because there was a lot of disbelief that the tariffs would actually be as extreme. But we've known that they were coming in some way, shape, or form. It's been talked about. We've known that volatility has been really needed, and we haven't seen it in a while. And we were expecting just natural volatility this year. So we have been proactively positioning our clients to get through this. So again, we don't want to be reactive. We want to be proactive. We don't want to be making any major moves right now. The only thing we'd want to be doing right now is taking advantage of this opportunity, especially if we haven't made our retirement contributions for the year. If you still have room to contribute for 2024, we have until April 15th to get those contributions in. So it's a great time. Take advantage of the dip, take advantage of the sale, put money into the market. But otherwise, we should just be holding tight. So again, take a deep breath, breathe easy, and I'm here if you need me.